Right now, the global equity market is pricing one of the most critical AI hardware companies on the planet for an absolute mathematical impossibility. Seriously, if you were buying SK Hynix today, you aren't just betting on the future of artificial intelligence. You are effectively betting that the unforgiving, brutal laws of semiconductor economics have just ceased to exist. Today, we're going to break down exactly what the market is missing here and why this setup is so incredibly dangerous for investors.
To put this into perspective, take a look at their valuation. We are talking about a 10.64 times price-to-book ratio. For a bit of context, SK Hynix's 5-year historical average is just 2.85x. This historically insane multiple is the undeniable proof point of a market that has completely detached itself from cyclical reality. Right now, Wall Street is pricing this highly cyclical, capital-intensive hardware manufacturer like it's a zero marginal cost software monopoly.
So, what does this all mean? Well, the crucial point is this. To justify today's valuation, investors literally must believe that the semiconductor cycle is dead. They're pricing in an extended, historically unprecedented supercycle where supply never ever catches up to demand and margins never compress. But before we get into exactly why that math is destined to fail, we need to understand the underlying economic engine that's actually driving all this euphoria. Okay, let's quickly dive into how this business actually makes its money. SK Hynix operates primarily through two memory segments. First, you have DRAM, Dynamic Random Access Memory, which is the powerhouse, driving a massive 60 to 70% of their total revenue. The second piece is NAND flash memory, making up the remaining 30 to 35%. They sell these memory chips to massive original equipment manufacturers and hyperscale cloud providers. These are the companies physically building out the infrastructure of the AI revolution. But why is SK Hynix the one winning right now? It boils down to a deeply technical competitive moat. And this brilliantly illustrates why they are the primary qualified partner for NVIDIA and this entire global AI build-out. They use this proprietary packaging technology called MR-MUF, Mass Reflow Molded Underfill. Without getting too bogged down in the weeds, MR-MUF offers vastly superior thermal dissipation and high-density stacking compared to anything competitors have. In the world of AI graphics processing units, heat management is everything, and this specific tech gave SK Hynix a massive first-mover advantage. And you can see how that technological edge translates directly into absolute market dominance. In the ultra-premium high-bandwidth memory segment, what we call HBM, SK Hynix commanded an absolute 56.4% global market share as of Q1 2026. Their biggest rivals, Samsung and Micron, are trailing way behind at just 21% each. This massive lead is exactly why the market is so absolutely euphoric about their AI positioning right now. They essentially own the choke point for high-end memory. And that choke point sits right in front of a rapidly, explosively expanding total addressable market. Global cloud service provider capital expenditures are currently forecasted to eclipse an astounding $600 billion in 2026 alone. A massive chunk of that cash is earmarked directly for the high-performance memory subsystems that SK Hynix dominates. The demand shift from legacy computing over to cognitive AI workloads isn't just a trend, it's structural, and it's immense. And by the way, if you like deep, evidence-based explainers like this, make sure you're subscribed. Now let's pivot sharply to the central conflict of the bear case, because this is where things get really interesting. What happens when the world's most notoriously cyclical industry is priced like a permanent SaaS monopoly? What actually happens when we look past the AI hype and do the cold, hard math on this valuation? Well, here is the terrifying reality. To mathematically sustain their current long-term equity valuation, holding other variables constant, SK Hynix would need to generate an ongoing operating margin of 123%. 123%. Alternatively, they'd need a terminal growth rate of 10.9%, which for context is more than 3 times the nominal GDP growth of South Korea. This isn't just an optimistic outlook, it is literally mathematically impossible. Now, the bulls are going to point straight to the recent financial results to justify this hype. And to be completely fair to them, the Q1 2026 earnings reported on April 22nd were an absolute blowout. Total revenue hit 52.58 trillion Korean won. That is up 198% year over year, shattering analyst expectations by over 6%. But look closely at that operating margin. 72%. That is a historically unprecedented peak, driven entirely by massive supply constraints and sky-high average selling prices for their premium chips. But when you zoom out to the broader historical picture, a very different, much scarier story emerges. Look at the revenue volatility over just the last 3 years.
In 2023, revenue crashed to roughly 32.7 trillion won during a brutal down cycle. In 2024, it doubled, and in 2025, it surged again. This is a stark reminder of the brutal cyclical whip that defines the memory industry. Peak margins of 72% simply do not last forever, especially not when competitors begin flooding the market with brand new capacity.
And speaking of capacity, listen closely to what management is actually telling us. During that same Q1 earnings call, CFO Kim Woo-hyun stated, and I quote, "Reinvesting operating cash flow directly back into strategically necessary capacity is the most effective use of capital." Now that sounds great during a massive boom, right? But it is the exact mechanism that creates the next bust. They are dramatically ramping up capital expenditures to build out new fabs and clusters, perfectly setting the stage for future oversupply.
This brings us to our qualitative scorecard, which reveals a truly fascinating dynamic. Based on the deep research, SK Hynix scores a stellar 9 out of 10 for market position, financial health, and profitability. Operationally, they're executing flawlessly, and they're sitting on a fortress-like net cash position of 35 trillion Korean won. But look down there at capital allocation, a glaring 5 out of 10. Despite having more cash than they know what to do with, management's decisions around how to fund their massive expansion are raising some huge red flags.
Which brings us to the core contradiction of this entire business right now. On one hand, you have absolutely flawless technological and operational execution. They are winning the AI race. But on the other hand, you have highly questionable peak cycle capital allocation. When management teams prioritize massive, aggressive capacity expansion at the absolute peak of the cycle, it's usually the minority shareholders who end up paying the price when that cycle inevitably turns. Before we dive into these scenarios, I want to mention that all of the research behind this explainer was created using Flash by StockSentinel.ai. You can generate deep research reports exactly like this one for literally any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. Now, if you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every single week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders for quality businesses built to compound for years, hidden gems for under-the-radar names with asymmetric upside, and dividend hunters for durable income with the fundamentals to back it up. There's also Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this explainer. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. All right, let's look at the 5-year scenario framework. Now, I need to state clearly, this is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. In our high case, assuming the AI cycle literally never breaks and they maintain their moat indefinitely, we model $180 billion in year 5 revenue and a premium 22x multiple. In the base case, where the market normalizes, competitors catch up, and margins revert to historical averages, that yields $110 billion in revenue and a 15x multiple. And in the low case, severe overcapacity triggers a massive down cycle, collapsing revenue to just $70 billion with a 10x multiple. If you want the full model with all the detailed assumptions, you can check out the full report on Flash. When you assign probabilities to these operational outcomes, let's say 25% for the high case, 50% for the base, and 25% for the low, and you actually do the math, the probability-weighted implied year 5 ADR price comes out to $69.12. Contrast that sharply against the July 2026 ADR share price of roughly $130. The underlying fundamentals here, even under generous base case assumptions, simply do not support the current price tag. Just let the gravity of this number sink in for a second. Negative 46.9%. That is the weighted 5-year total return implied by this framework. And here's the thing. This massive potential capital destruction isn't happening because SK Hynix is a bad company. Not at all. It's simply the mathematical consequence of buying a highly cyclical, capital-intensive hardware manufacturer at peak cycle margins and historically unprecedented valuation multiples. And the risks here aren't just theoretical. Management is actively making choices right now that pressure the stock. Remember that pristine 35 trillion won net cash position we talked about? Despite having a veritable fortress of a balance sheet, management bizarrely chose to inflict a 2.5% shareholder dilution via a $26.5 billion equity offering during their July 2026 NASDAQ ADR listing. Apparently, 35 trillion won just isn't enough pocket change for them. Leveraging dilutive equity at peak valuations to fund capex is a massive warning sign for investors. Because those capex plans are terrifyingly large, and they represent the core risks that could absolutely break this thesis. They are planning a monumental 1,100 trillion Korean won domestic cluster investment. As SK Hynix executes this massive build-out, you have deep-pocketed competitors like Samsung and Micron aggressively ramping up their own high-bandwidth memory capacity to steal that high-margin market share. And from the bottom up, you have China's CXMT scaling commodity memory production, threatening structural pricing pressure across standard DRAM. Make no mistake, the supply glut is coming. So what should you really take away from all of this? Let's recap. First, SK Hynix truly has an unrivaled AI memory moat right now. Their tech is the absolute gold standard for powering this phase of the AI revolution. Second, their current valuation requires a mathematically impossible permanent supercycle to actually justify. And third, the brutal gravity of the semiconductor cycle always wins in the end. When supply scales up, and it will, peak margins inevitably collapse. Ultimately, the market is betting heavily that this time is different. But in the highly capital-intensive world of semiconductor manufacturing, it almost never is. The real question isn't whether SK Hynix is a great company. It absolutely is. The question is whether any company can outrun the cycle when everyone in the industry is building capacity at the exact same time. If you want the full research, including the deeper framework behind this explainer, you can get it free at flash.stocksentinel.ai. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.